Hey everyone, it is Victor with BCM and welcome to Asset Allocation, the most important decision. Asset allocation is a topic that I've talked about before in other videos, but it is also a very important topic and it is worth its own focused discussion. So that's what we'll do in this video. We're going to start with the basics and just do a quick review of what asset allocation is. Next, we'll talk about why asset allocation is important and why investors should pay close attention to it. And then last, we'll go over a example of how asset allocation works in the real world. So what is asset allocation? Asset allocation is a very simple investment and portfolio management concept that is exactly what it sounds like. It describes how a portfolio is sliced into different types of investments or asset classes. For example, the pie chart on the right is equally sliced into 4 asset classes with 25% allocated each to stocks, bonds, commodities, and real estate. These are 4 of the most common asset classes. Investors often like to split these asset classes up into subcategories. For example, U.S. stocks versus foreign stocks, government bonds versus corporate bonds, and so on. Investors can adjust and manage their allocations to look whatever they want it to look like. Some people will get very detailed and very precise. Others will leave it pretty simple. Either way, allocation represents an active investment decision because it's a decision that we have to make. Portfolios don't allocate themselves. Now, even though asset allocation is a simple and basic concept, it is still one of the most important investment decisions we can make, and that's for at least a couple of reasons. Number one, asset allocation is one of the most effective tools for managing portfolio risk or volatility. I made a separate video about risk and return where I explain why volatility is important and why it's crucial to understand. If you're not familiar with volatility or you just want a refresher, then I recommend you go and watch that video. I'm going to put a link of it in the description below. Number two, the second reason why asset allocation is so important is because it is a major determinant of long-term portfolio performance. Some people argue that asset allocation is the only investment decision that affects returns. I'm not totally convinced that's the case, but I do recognize that asset allocation is a very important factor, and we'll talk more about how and why that is in the slides ahead. We'll start with risk management and asset allocation. Here is an example that shows how asset allocation can help us manage risk and volatility. So on this page, we have 2 different allocations, 2 portfolios, A and B. A is allocated 100% to stocks. Let's just say the US stock market, like the S&P 500. That's the red portfolio. Allocation B, portfolio B, is allocated 50% to stocks and 50% to cash, which is earning a 0 return. Next, let's assume that the stock market, the S&P 500, falls by 40%. Well, in that case, we would expect allocation A to also fall by 40% because it is 100% invested in the stock market. On the other hand, allocation B is only expected to fall by half of that amount, or 20%. And that's because only half is allocated to stocks, while the other half is allocated to cash, which doesn't move. Again, this is clearly a very simple and basic concept, but we can see that it is also very effective. Allocation B has effectively placed a 50% limit on the portfolio's risk exposure, and because of that, it's also greatly reduced the portfolio's volatility. If you don't understand why that matters, why volatility is so important, then please watch the risk and return video in the description below. Beyond this surface level risk reduction that we can see, asset allocation can also offer a second order level of risk reduction that is hidden. It has to do with something called correlation. In terms of investing, correlation is just a measure of how two investments or two assets move relative to each other. So how the prices or values change relative to one another. For example, in allocation B on the previous slide, we saw that we had stocks which went down and then cash which didn't go anywhere. Now instead, we could have an allocation where we joined stocks with an inversely correlated asset. In other words, when stocks go down, the inverse asset goes up. That's what we have here in allocation C. We have a portfolio that is 50% in stocks and 50% in another asset that is inversely correlated. It doesn't matter what it is, it's just inversely correlated. It moves opposite of stocks. So with the same example, if stocks fall 40%, but this time the inverse asset goes up 20%, then we should expect portfolio C to only be down 10%. That's just 50% of each asset return. However, in reality, the return could actually be better than that. And that's because correlation is like a hidden value that can affect returns, in this case, improve them. Now, there's actually an entire field of study dedicated to this. It's called modern portfolio theory, or MPT for short. I did a couple of videos a while back that explains MPT, how it works, and all that. I'll put a link in the description below so you can check it out if you'd like to. But the takeaway here is that a portfolio's risk and return characteristics can be manipulated, and it can be manipulated to work in our favor through correlation and asset allocation. The second reason asset allocation is so important is because it is a primary determinant of portfolio performance over time. If we think about the different investment decisions that can affect portfolio performance, there are really only so many, right? One is security selection, which is like stock picking. Should we buy Apple or Bank of America or Home Depot or something else? Second factor is market timing. That's just deciding when to jump in or out of the stock market. And of course, there's also asset allocation, which is how much do we allocate to stocks in the first place? Now, there has been an extensive amount of research done on this topic over time, studies on performance attribution and whatnot. And most of these studies have concluded that asset allocation is the most influential, most important factor. The most famous study, the most well-known at least, is known as the BHB study after its authors. And it found that roughly 94% of portfolio performance could be explained by asset allocation decisions over time. There have been additional studies as well. Some show that it's more like maybe 70%, maybe it's 80%. But whether it is 70, 80, or 90%, it is still the biggest slice of the pie. And that makes it very, very important, if not the most important investment decision. Now, the BHB study, that was possible because of earlier research done by other people like Dr. William Sharp and Dr. Harry Markowitz, who were some of the founding fathers of modern portfolio theory, of MPT. They actually won the Nobel Prize in financial economics for their work. I referenced kind of their seminal studies here on this page so that you can look them up if you want. But the takeaway is that asset allocation, based in part on the principles of MPT, has really become the foundation for modern day professional portfolio management. And it wasn't done by chance, right? It happened through decades of academic research and industry practice that said it works. Okay, so we know what the studies tell us, but seeing is believing. So what we're going to do now is we're going to look at another simple example, but in numbers, that will help us see how asset allocation can dominate other decisions. Here's another simple example that is similar to our previous ones, but we're going to take it a step further this time. So let's say that I'm telling you that I picked a stock and I bought it and it went up a lot. It went up 100% after a year. So I doubled my money. Now I'm telling you all about it and you're thinking, wow, that's great. You're really smart and all that. But then you ask me, how much money did I allocate to that stock? How much of my portfolio did I allocate to that stock? And it turns out that I only allocated 1% of my portfolio to that stock. And the other 99% was sitting in cash that was earning nothing. So, so what I really happened here, what I'm saying is that I actually only earned 1% on my portfolio. It had little to nothing to do with my stock picking ability and a whole lot to do with my allocation decision, right? This is summarized on the table you see here on the right. Now, let's take this a step further. Let's say that I actually had the foresight and the nerve to allocate 100% of my portfolio to that stock. In that case, I really would have made 100% on my entire portfolio. I would have doubled my money. And that's great. But in order for my portfolio to maintain that same level of growth after year one, uh, that stock will have to continue going up 100% year after year, which we know is not going to happen. That's not feasible. And so that means at some point, I'm going to have to sell that stock and I'm going to have to pick another one. Now, what are the chances that that next stock and the one after and the one after that, what are the chances that they will all go up 100% a year? I think you know where I'm going with this. Eventually, the law of averages will take over. The reality is I'll have some good picks, but I'll have some bad picks too. And in the end, my picks, they're all going to average out. So over time, my picks, they matter less and less. Meanwhile, my allocation matters more and more. In the end, it is the decision to allocate to stocks and how much to allocate that has the biggest impact on portfolio performance. It is why asset allocation is the most important decision. This is our last example, and it's going to show how asset allocation works in reality and not just in simple made-up examples. We are comparing the actual historical performance of two different portfolios. One uses a simple equal weighted asset allocation of 5 asset classes, and the second is just 100% US stocks. The allocations are shown on the left. The time period we're looking at is from January 1999 out to April of 2022. I kind of cherry-picked this time period, not only because of data availability, but also because it captures two of the largest market crashes in modern history, the dot-com crash, as well as the financial crisis. So let's look at the results on the table on the right. On row 1 of the table, we see annualized return. The allocation portfolio, which is shown in column B, we see that it earned 6.04% per year. The stock portfolio, which is shown in column C, earned 7.56% per year. In column D, we compare the allocation portfolio to the stock portfolio, and we see that the allocation return was about 80% of what the stock return was. Moving down to row 2, we see standard deviation. This is a measure of volatility. It is a quantitative representation of risk. The allocation portfolio had a standard deviation of 7.8%, and stocks had a standard deviation of 15.53%. So looking back again at column D, we can see that the allocation portfolio earned 80% of the return that stocks did, but it only had 50% of the risk. This is a real-world example of manipulating a portfolio's risk and return characteristics to work in our favor. This is like the holy grail for investing. Like everyone is looking for more return and less risk, as much as possible anyway, and this is doing exactly that. We're getting 80% of the return with only 50% of the risk. Check out row number 3, maximum drawdown. This shows us the worst decline from top to bottom during the period. We can see that stocks at one point fell by over 51%, but the allocation portfolio only fell by less than 21%. That's less than half the downside of stocks. Row 4, beta. This compares how much the allocation portfolio moved relative to stocks. The stock market has a beta of 1. And so the 0.39 measure for allocation tells us that the allocation portfolio moved around about 61% less than stocks did. The next row, alpha, measures the excess return the allocation portfolio delivered based on the level of beta exposure, based on the level of risk as defined by beta. We want that measure, we want alpha to be positive, and we can see that it is. The remaining ratios are just different measures of risk-adjusted returns, and basically we want them to be positive, and higher is better. We can see that across the board they are positive, and they are higher for the allocation portfolio. So the bottom line is that any rational, risk-averse investor should prefer the allocation portfolio because it delivers a superior combination of risk and return, as shown by all these superior risk-adjusted return measures. And keep in mind, this was just a really generic equal weight allocation. It's nothing fancy, right? But still, it worked pretty well. Now, in practice, I mentioned before that professionals spend a lot of time fine-tuning their portfolios. They use different tools and techniques, portfolio construction software that not only look at historical data, but also make all kinds of customized assumptions. And they do all this to design and optimize their portfolios. The process is called portfolio optimization, no surprise. The last thing I'll say here, which I actually say quite a bit, is that it doesn't matter how sophisticated or how fancy our tools or our models get. At the end of the day, we can always be wrong. Past performance is not indicative of future results, and investing is risky. We can lose money doing it. So don't go out and buy some super fancy software package and think that it'll make you invincible or bulletproof, because it won't. All right, we went over a lot, so here is a quick summary. Asset allocation is how a portfolio is allocated to different types of investments or asset classes, such as stocks, bonds, real estate, and so forth. Asset allocation is a simple and basic concept, but it is also one of the most important investment decisions that we can make. That's because asset allocation is crucial to managing portfolio volatility or risk, and it is also a major determinant of long-term portfolio performance. Investment professionals take asset allocation very seriously. They spend a lot of time optimizing their allocation decisions, and when they do it correctly, it can be used to alter the risk return characteristics of a portfolio and make them work in our favor. Finally, remember that just because something looks good based on back-tested data or some fancy software package, it doesn't mean that it's going to work the same way moving forward. Investing always has been and always will be risky business, and we can lose money if we're not careful. That does it for this video. Thank you for watching. If you like the content and you want to see more, please like, subscribe, and turn on your notifications. If you have questions or comments, leave them below, and I will do my best to get back to you. Thanks again.